So, imagine walking up to your bank on a Tuesday morning. The sun is out, you have your coffee, and you just need to make a simple withdrawal.
Right. Maybe you need to pay a contractor or cover payroll for your business.
Exactly. You pull on the glass doors, but they do not open. You look closer, and there's a taped-up piece of paper right at eye level. It reads, "We cannot return your money right now."
It sounds like a scene from 1929, or maybe a flashback to the collapse of Lehman Brothers in 2008.
Yeah, but this is not a history lesson.
Mm-hmm.
This is happening right now, this week, in the dead center of the U.S. financial system.
It really is.
And that is exactly why we are doing this deep dive today. We need to cut through the noise immediately. We are looking at the latest breaking news, and I want to give you the conclusion right up front, the soft landing narrative. It is entirely dead.
Completely dead.
We are talking about a massive insolvency crisis at a major private credit firm called Blue Owl. And the really scary part is that the containment narrative is broken. The latest data indicates we are entering a credit freeze reminiscent of 2007.
Yeah, the markets are flashing red, banks are falling, tech is distributing stock to retail bag holders, and the smart money is actively fleeing to gold and bonds.
So our mission today is to strip away all those everything is fine headlines and expose the actual mechanics of this collapse. Because if you are holding AI stocks, banking stocks, or just cash in the bank, you need to understand the big picture of why this is happening.
Right, we are going to explain how a shadow bank failure breaks the supply chain of money, and we'll get into why this specifically endangers the artificial intelligence infrastructure build-out.
Which is a huge piece of this puzzle. Plus, we will look at why the fear gauge, the VIX, just hit a panic level of 35.
We have to look at the plumbing of the financial system because right now those pipes are bursting.
Let us start at ground zero. The firm is Blue Owl. The stock is down over 60% from its January peak. That is a massive haircut. But the price drop is not even the biggest story here.
No, not at all. The price is just a symptom. The actual disease is liquidity. Blue Owl has effectively shut the gate. They permanently closed one of their funds and halted redemptions.
Halted redemptions. That is the polite finance way of saying, we have your money and you cannot have it back.
Exactly. In the financial world, trust is really the only currency that matters. When a firm locks the doors, they are admitting they have a severe liquidity crisis. They are basically saying, if we let you take your cash out, we collapse.
Wow.
But what is really fascinating and honestly pretty terrifying about the latest reports is how they are trying to survive right now.
Because usually, when a firm is in trouble, the playbook is to sell off the bad assets, right? You get rid of the toxic stuff to clean up your balance sheet.
In a functioning market, sure, but we are not in a functioning market. Blue Owl is not selling their bad loans because nobody on earth wants them.
Right.
Instead, they are cannibalizing themselves. They are selling their absolute best assets, the crown jewels, to large insurance companies and public pension funds.
Wait, hold on. If they sell the only things that are actually performing and making money, are they not just guaranteeing they will fail later? You are getting rid of your income stream?
They are, but they have absolutely no choice. Think about who the buyers are here. Insurance companies and pension funds are heavily regulated. They literally cannot buy junk-rated debt. Their charters forbid it. They can only buy high-quality assets. So, to raise cash immediately just to keep the lights on for another week, Blue Owl has to sell its best performers.
That feels like burning the antique furniture to heat your house because you ran out of firewood.
That is the perfect analogy. You burn the furniture to survive the night, but eventually you run out of furniture and you freeze anyway. And the market knows this is happening. Which brings us to the valuation shock. We have seen reports regarding hedge fund manager Boaz Weinstein.
I saw this in the breaking news. He is known for spotting distress. He offered to buy stakes in the fund, but definitely not at face value.
Far from it. He offered to buy at a 20 to 35% discount.
20 to 35% off.
Yes, that is the number you need to remember. That is the real price. The market is screaming that these assets are worth significantly less than the sticker price Blue Owl claims. This is price discovery happening in real time, and it is revealing a massive hole in the balance sheet.
Because if the best assets are worth 30% less,
what are the bad assets worth?
Pennies on the dollar.
Or zero. And it is not just the financial sharks circling. The politicians are getting involved too. Senator Elizabeth Warren just made a comment about shadowy private credit firms blocking withdrawals.
And when you get that level of political heat, that signals regulatory crackdowns are probably coming.
It does. It adds even more pressure to a system that is already cracking. It scares away any potential saviors, But look, if Blue Owl was just one isolated firm, the U.S. economy might be okay. We can handle one bankruptcy. The real problem here is the contagion.
Let us talk about that contagion, because I think a lot of people listening might be thinking, okay, I do not invest in private credit. I do not use Blue Owl, so I am safe. Why does this spread to Main Street banks?
To understand that, you have to understand what private credit actually does in the modern economy. Over the last decade, big banks pulled back from lending to small and mid-sized companies because of stricter
I
regulations.
take heightened up.
So private credit stepped in, they became the grease for the economic engine, they fund payroll, they fund inventory, they fund receivables for mid-sized American businesses.
So if you are a mid-sized manufacturing company in Ohio and you need cash to operate, you are not going to the big national bank anymore.
Often, no. You are going to a private lender like Blue Owl because they are faster and have looser rules. But here's the problem. If Blue Owl stops lending,
The manufacturing company runs out of cash.
correct, they cannot buy inventory, they cannot make payroll, they lay off workers, and eventually they default on their existing loans.
And I assume they have loans with the big traditional banks too.
Precisely. That is the transmission mechanism. The market has realized a very simple truth. If the loans held by private credit firms are going bad, the loans held by the traditional big banks are likely going bad too. They are lending to the exact same economy.
You cannot have a recession in private credit land and a boom in banking land.
Exactly. And we're seeing this in the charts right now. The bank ETF, ticker XLF.
It is undeniable.
Yeah.
The XLF has broken key support levels. If you overlay the chart of the big banks with the chart of Blue Owl, they were tracking closely together, and now both are plunging.
The market is pricing in a systemic banking problem, not just a shadow bank problem.
And looking at the consumer reality makes perfect sense. The latest data about the holiday season was pretty grim.
It was incredibly weak. Inventory is piling up in warehouses all across the country. If businesses cannot get credit to bridge the gap between that unsold inventory and their next season, we are facing a massive wave of corporate defaults. That is how the contagion moves.
Okay, so we have a credit freeze hitting small businesses and dragging down big banks. That is bad enough. But here is the curveball that I think surprises a lot of people when they look at this latest news: the AI connection.
Yes. This is where the story gets really interesting and really dangerous for the broader stock market.
We usually think of AI as software, right? It is code, it is the cloud, it is weightless. Why is a gritty credit crisis a threat to the shiny AI tech boom?
This is the biggest myth in tech right now. People think AI is lightweight. The reality is that AI is heavy industry. It is much more like building a railroad or a steel mill than writing an iPhone app.
It requires massive capital expenditure, CapEx.
Huge amounts of it. We are talking about building gigantic data centers, concrete, steel, massive cooling systems, and buying billions of dollars worth of chips.
So it is hardware intensive. It requires real physical stuff.
Incredibly so. And hardware costs cash. Look at Oracle. The data points there are very telling. They had negative free cash flow last year, and they are projected to have even more negative cash flow this year.
And just to clarify, negative free cash flow basically means they are spending more cash than they are bringing in from their actual operations.
Right. They are burning cash to build the infrastructure for the future. But to do that, they absolutely need to borrow money. They need the credit markets to be open and flowing. They are relying on debt to build the railroads of the 21st century.
Oh, I see where you're going with this. If the credit market freezes because of this Blue Owl contagion.
The cash hose for the AI build-out turns right off. It is that simple. Tech companies cannot refinance their massive debts. They cannot borrow the billions they need to finish those data centers.
So all those half-built server farms and massive chip orders,
They get stalled. And this is why we are seeing such strange behavior in the tech stocks right now, specifically the NASDAQ, the QQQ. There's a technical pattern playing out called the Wyckoff distribution pattern.
okay, let us unpack that. Wyckoff distribution. It sounds complicated. Can you give us the plain English version of what that looks like?
It is actually quite intuitive. Imagine a stock price rallying up, hitting a ceiling, and then just moving sideways for a while. It looks boring, right? But while it is moving sideways, the volume of trading actually surges.
What does that massive volume tell us?
It tells us that the smart money, the institutions, the insiders, they are selling their shares. They are distributing their stock to retail investors, the bag holders, who are still buying the media hype. The smart money is getting out before the drop, and they are using that sideways movement to hide their exit.
That's pretty cynical, but it makes total market sense. They are basically handing off the grenade.
It is pure market mechanics, and the signal that this distribution phase is over, the breaking of the 100-day moving average.
Which we have just seen happen in the charts this week.
We've just seen it. The markdown has begun. The tech sector is waking up to the fact that without easy credit, the AI CapEx cycle is in serious trouble.
This paints a picture of capital fleeing risk everywhere. But if money is leaving tech and it is leaving the banks, where is it going? Usually in a global crisis, people say cash is king, right? Everyone rushes to the US dollar.
Usually, yes. In a global crisis, the world rushes to the dollar, but not this time. The US dollar is weakening significantly, represented by the DXY index.
Why is the dollar getting hit? If the U.S. economy is in trouble, does that not usually help the dollar because it is considered the cleanest dirty shirt in the laundry?
Normally, yes. But we have a perfect storm of political and economic uncertainty right now. First, you have the recent Supreme Court ruling striking down those Trump-era tariffs. That removes a source of perceived strength, or at least an aggressive trade posture. But then you have the new administration proposing a flat 15% global tariff.
That sounds like it just creates a massive amount of chaos for global trade.
It creates massive uncertainty, and markets hate uncertainty even more than they hate bad news. On top of that, the slowing U.S. economy, which we just discussed with the credit freeze, makes U.S. assets much less attractive to foreign investors. J.P. Morgan has actually come out and said this looks like the start of a multi-year downtrend for the dollar.
Wow. So if the dollar's out and stocks are out, what is the ultimate safe haven right now? Is it gold?
Gold and silver. It is the classic inverse relationship. As the dollar weakens and credit fear rises, investors flee to hard assets. They want assets that cannot be locked behind a gate, like a blue owl fund.
But has gold not been hovering around all-time highs for a while now? Is there really any room left for it to run?
That is actually the bullish signal. Hedge funds, the smart money, they have not even fully loaded up on gold yet. Their net long positions are relatively low compared to historical peaks.
Interesting.
This means there is massive fuel left for the rally. As the panic really sets in, they will be forced to buy, which drives the price even higher. They are currently underallocated to the only life raft that's actually working.
Now, what about bonds? This is one that always confuses me, and I know it confuses a lot of you listening as well. We constantly hear inflation means high rates, and high rates mean bond prices fall. So should bonds not be a terrible bet right now?
That is the standard narrative you hear on the nightly news, but you have to look at the actual mechanism. We need to look at the Treasury market, specifically the long bond, the TLT.
Walk us through that mechanism. Why are bonds the play right now?
If you look at the correlation, the dollar and the 10-year Treasury yields move together. If the dollar crashes and if economic growth stalls due to this credit crunch we are seeing, yields must come down.
Why must they come down?
Because there is absolutely no demand for capital if the economy is frozen. Nobody is borrowing to expand their business. And if the economy crashes, the Federal Reserve will eventually be forced to cut rates to try and restart the heart of the economy.
And in bond land, lower yields mean?
Higher prices. It is a seesaw. When yields go down, the value of the bond goes up. This makes U.S. Treasuries the ultimate safe harbor alongside gold in a deflationary crash.
So the smart money playbook right now is essentially sell tech, sell banks, buy gold, buy bonds.
Precisely. It is a defensive rotation. They are battening down the hatches.
I want to circle back to the fear gauge you mentioned in the intro, the VIX. Because looking at the S&P 500 today, it does not look like a total crash. It looks nervous, maybe, but not catastrophic.
That is what institutional traders call the duck-on-water scenario.
Duck on water.
Calm on top, but paddling furiously underneath. The broad indices, like the S&P 500, are weighted by these huge mega-cap companies, so they move very slowly. But underneath the surface, individual stocks are experiencing record volatility.
And the VIX is catching this underlying panic.
Yes. Goldman Sachs reported desk activity indicating that the VIX implied volatility is touching 35.
35. Put that number in context for us. What is considered normal?
Normal is 12 to 15. 20 means the market is cautious. 35. The last time we saw levels like this was during the significant market drop in early 2025. A VIX at 35 is not a simple correction. It is panic.
Wow.
It tells us that the big players are paying huge premiums to insure their portfolios against a major crash. They are terrified of what is coming.
It really feels like we are watching a slow-motion car crash, but only some people are looking out the window.
That is a great way to put it. It is a nonfiction financial thriller playing out in real time. Think about the narrative arc we have just traced.
Let us recap it for everyone listening, just to lock the big picture in.
It started in a private credit fund, Blue Owl locking its doors. That was the initial spark. Then it moved to the traditional banks, dragging down the XLF because the loan books are intimately connected. Now it is choking off the AI capex cycle because big tech needs cheap debt to build their infrastructure. And finally, it is forcing all that capital to flee into gold and bonds.
So it's entirely systemic. It is not just one bad company making bad bets in isolation.
No, absolutely not. We are witnessing the unraveling of the post-COVID credit bubble. The Blue Owl event is not an isolated incident. It is just the first domino in a massive systemic repricing of risk across the entire U.S. economy.
So bringing it all home, what does this all mean for the person listening to this right now?
It means we need to fundamentally rethink what safety actually means.
You know, I want to leave you with a thought that really stuck with me while we were preparing for this deep dive. We started the show talking about Blue Owl locking the doors on their investors.
Yes, the gate shutting.
If a multi-billion-dollar financial firm can simply lock its doors and refuse to return investor capital, how accessible is your wealth, really?
That is the truly provocative question. If you are sitting in a supposedly safe 60-40 portfolio, 60% stocks, 40% bonds, and that portfolio is deeply exposed to this cascading credit freeze, are you holding a real asset? Or are you just holding an IOU that might not be honored when the real panic hits?
It is a chilling thought.
Yeah.
Liquidity is only there until everyone needs it at the exact same time.
Exactly. When the music stops, you want to be holding the chair, not wandering around looking for one.
We will definitely be keeping a close eye on the credit spreads and the VIX in the coming days. Remember, do not just watch the shiny stock tickers. Watch the plumbing of the system.
Stay vigilant. The data is telling a very clear story.
Stay safe out there. Thanks for joining us for this deep dive.